I'm Lauren Hayes, and today we're talking about real estate investment with Andrew Lockhart, CEO and Managing Partner at Metrics Credit Partners. Andrew, nice to meet you.
Hi, Lauren. Thanks for having me.
Now, for someone hearing about Metrics Real Estate Multi-Strategy Fund with ticker MRE for the first time, how do you describe what the fund is trying to deliver and for what type of investor?
It's really designed to give investors a total exposure to real estate investments. At one end of the risk spectrum, we see investors that want to invest in private debt in real estate to have the characteristics of a defensive asset class to protect and preserve capital. At the other end of the spectrum, you're looking for clients that are looking for equity exposure and how to generate a higher total return. So I've kind of looked at this, and we've decided that we think that one of the ways in which investors can get a very good income from real estate investments is through private credit invested in real estate debt. So MRE was designed to bridge both, participate across the full capital structure from real estate debt through to real estate equity, and it's 50-50. And so 50% of the capital is invested in a portfolio of real estate debt investments, senior secured, predominantly first registered mortgage debt, diversified across about 145 individual loan assets. Then at the other end, the other 50% of MRE is invested in a portfolio of property development transactions, where as the projects are being completed, on completion of the project, the asset is sold, repays the return to the investor. And so it's what we call a stapled security. On the 50% in the real estate debt side, we're distributing the interest and income and fees that are generated on a portfolio of private debt investments. On the other 50%, it's an active trust. And so as those projects are completed, we pay the tax and then we wind up the SPV and we distribute the returns to investors, hopefully in the form of fully franked dividend distributions.
So when investors buy MRE on the ASX, what are they really getting exposure to? Can you give a couple of real-world examples of the types of commercial real estate investments the fund holds across Australia and New Zealand?
Sure. We're a very large investor in private markets. And so we've supported a lot of clients. In fact, as a business, we lend over $14 billion of real estate debt investments. In MRE, investors are gaining exposure to a fund that we established back in October of 2017. And so it provides, that fund is around about $5 billion in assets under management. And it's really around industrial and residential development. We also have a small amount of retail and commercial assets, but predominantly it's short-term development financing that we're involved in. And so when you look at the demand for credit to build high-density residential housing to meet the housing demand in Australia, we're a significant part of providing debt financing to our clients to be able to do that. On the equity side, it's again focused primarily on industrial and residential development. So a real live example would be, we're involved as a 50-50 joint venture partner at a site at Five Dock to deliver 1,185 apartments together with a retail shopping component. So over 4 separate buildings that will be completed over a number of years. We've acquired the site. Our joint venture partner controls all of the construction aspects and the delivery. And so the site has the appropriate planning. We've got all of the necessary approvals. The demolition has occurred. The excavation is underway for stage 1. So in stage 1, we'll deliver over 600 residential apartments at Five Dock, minutes to the new metro rail station. So again, on completion of that project, as the buildings are built, consumers that have entered into agreements to purchase the units on completion of construction, they're our source of return of our, one, repaying the debt, and also providing any surplus that can then be distributed back to our investors. So it's really important in the context of MRE. People understand our real focus is around management of risk. When we lend money, we're focused on where we sit in the capital structure, appropriate terms, conditions, pricing, the taking of security designed to protect ourselves. When we look at our real estate equity portfolio, it's about being invested with good quality partners that have got a good track record in planning, in construction and delivery, on sales and marketing activity, because we're relying on them to be able to undertake a lot of that work. We're really there as their financial partner to support the development of the transactions.
So MRE targets a total return of 10 to 12% per annum, net of fees with monthly cash income. So how are you aiming to deliver that in practice, and what does that translate in terms of income for investors today?
The income that's currently generated in MRE is coming from 50% of the capital that's been deployed into the real estate debt portfolio. So our real estate debt portfolio as a whole has delivered around 6.85% over the 90-day bill rate since October of 2017. And because only half of your capital is invested in income generating assets today, instead of receiving 11% plus return today, you're receiving 50% of that as income. So that fund is giving a monthly income cash distribution from a portfolio of primarily senior secured private debt investments. The balance of the income comes as we complete the projects and we realize the profits. It comes in the form of a dividend distribution because that's where we're holding the equity positions. And so in those projects, as those projects are being completed, you're recognizing the profitability or the future income that's going to come on completion. So if you think about it, you're developing a project to build a certain number of apartments. I can understand how many apartments we'll build, what we think the revenue will be or the sale price, and that's our income. Then when you look at the costs, it's the cost of the land, it's the construction costs, it's the financing and holding costs, the sales and marketing costs. That leaves you with, hopefully, a surplus at the end of it. And if we're successful in terms of those projects, then that surplus, our share, less the share of our joint venture partners, then becomes the profit distribution to our investors. And that's paid out by way of a dividend distribution. So there's a little bit more lumpy income that would come from MRE from the equity side. But what we've tried to do is provide a baseline holding income, very attractive in terms of the returns that are being generated. But really what MRE is seeking to deliver in the short term is a total return in excess of the minimum target, where we're delivering income from the real estate debt investments with future or growth in the NAV as the projects are being delivered. So in the first 12 months since we launched the fund in October of 2024, we've well exceeded that in terms of the income distribution together with the traded increase in the NAV of the fund. Currently, though, it's trading at a discount on the market. So the market isn't recognizing the fact that growth in the NAV is really a future income distribution that will be paid to investors.
So in the current rate and property cycle, what are the key portfolio risks and how are they managed in practice, including through LVR settings, covenant structures, and diversification limits?
Yeah, it's really important. On the debt side, it's very much about ensuring that we're lending on appropriate terms, conditions, pricing, appropriate covenants, and that we've got all of the necessary controls. So metrics as a lender, we've been doing this for a very long period of time. Our first fund launched back in June of 2013. So the lending that we have is as a result of directly originating transactions with our borrowers, negotiating the appropriate terms, always looking for what is the source of cash flow that is going to service and repay our debt. And so, that's about selecting good customers that we want to do business with and then looking to do repeat business. But generally, you would want equity to be at risk of first loss. So on the debt side, it should be a lower risk investment than an equity investment. On the debt side, just to round that out, the main risks that an investor would be exposed to on the debt side is really the risk of a loss in the event of a default of a borrower. So diversification is very important, ensuring that you've got, and so in MRE, investors have exposure to 145 individual borrowers, where that provides for very good diversification. On the equity side, the risks are a little bit different because we're taking market risk. So there are a number of risks that you need to be careful about. One is planning risk. Are we likely to be able to get a rezoning or the development approval of that site that will provide for the future development of a project? The second thing that you're looking at is market risk. So are we able to sell the completed product for the price that we expect to be able to achieve? And so one of the advantages I think we have is the fact that we see so many projects around the country. We know all of the various competing sites in terms of selling rate per square meter for a residential high density apartment building and across the country in different areas. Then the third risk that you're looking at is the delivery or the construction risk. And so again, it's about who's going to undertake the work, what experience they've had, what are the risks around, variations, extension of time, wet weather, all of those things can have an impact, construction costs. So our role is to really understand the planning risk, understand sales and marketing risk, understand the construction. And then at the end of it, it's about making sure that our joint venture partners delivering a project on time and on budget, because obviously we're trying to maximize the return that we can get for our investors. And so that surplus, the final risk that might occur in, say, building a residential apartment is if people that have agreed to pre-purchase or enter into a pre-sale agreement, at the end of construction, they're issued with a construction completion certificate and we're looking for settlement. And if they don't settle, that's another risk. So there's a couple of key risks that we always have to monitor. And a big part of that is the due diligence and work that our team does, both on the debt side and on the equity side, to ensure that we're delivering good outcomes for our investors.
So, how is listed private real estate exposure through MRE different from owning a REITs or a direct investment property in terms of volatility, income, and access to opportunities?
Fundamentally, we think that the way in which you can maximize the return for investors in real estate equity investments is through active development. I believe that investors can secure an attractive income from a debt investment for lower risk than equity. So a lot of traditional REITs have acquired, say, a retail shopping centre or commercial office buildings, and the return to an investor is based on the rental income that's charged to the tenants, less any capital expenditure works to maintain the asset, and less any borrowing costs, and they're paying out the net distribution. So what we find is that, you can have a lot of variability and volatility around that income, because it might be that, there's increased vacancy risk, or you might have a situation where interest rates rise, which might impact the valuation of the property. So to lower that risk, but still be able to generate an attractive source of income, we think it's better to invest in the debt part of the capital structure, where equity wears the risk of volatility of asset prices, equity wears the risk around vacancy rates. And so we think you can get a more stable, lower risk investment in debt to generate an attractive income. And as I said, in our real estate debt fund, it's delivered 6.85% over the 90-day bill rate, so around 11 odd percent in the last 12 months through debt investments. And then on the equity side, we believe that it's about adding value. So taking a former industrial site and converting it into a high use residential site, the profit that can be generated through the value adding process around, planning outcomes, undertaking successful marketing and development of that project, undertaking successful delivery and construction, you're adding value. And as a result of that, you're expecting as your feasibility to be rewarded for that. So most property development transactions would be looking for a return greater than 15-20% to justify the risk of equity invested. And so that's why it's a higher risk, higher return part in MRE. But I think the combination of the two is very attractive, because you've really created a hybrid product, one where 50% of your capital is well diversified in lower risk debt investments, and 50% of your capital is exposed to higher risk, higher potential returning investments through the real estate equity portfolio.
Many investors know metrics from MXT and MOT already. Where does MRE sit alongside those funds? What makes it different? And how might an investor think about using MRE as a complementary exposure in their portfolio?
Yeah, in a portfolio, I believe that private debt and private market investments can play multiple roles. At one end of the spectrum, investors are looking for defensive assets, so private debt. MXT is very much a pure play private debt investment vehicle, well diversified across around 350 individual borrowers, large scale, competitive cost structure, and as a result of that, it's protective of investor capital but driving a very attractive return. And it fits more of the defensive alternative. So what we see there is people looking to take cash out of, say, a bond fund, or reduce their exposure to hybrids and have a defensive investment allocation as part of their portfolio, as part of a well-diversified portfolio. MOT and MRE are really more of that hybrid end, where an investor's looking for a higher yield maybe taking a little bit of money out of their equity portfolio, combining part of their defensive together with their growth allocations in a portfolio, looking for a higher total income. So some end of the spectrum, people want lower risk, more defensive characteristics, MXT. MOT and MRE, people are looking to invest in that to get a higher total return. And that comes through both the private debt investments and the equity. If I look at MOT, MOT is slightly different in that it has a mix of not only private debt investments, it also has exposure to a number of private equity investments in corporates, as well as private equity investments in real estate. MRE was designed to be the pure play real estate vehicle. We get a lot of clients that feel very comfortable understanding the asset-backed nature of real estate investments, and they didn't want the corporate exposures. And so in MXT and MOT, there are corporate business risks and business exposures to those assets. In MRE, it's a pure play debt and equity investment into real estate.
So if someone is thinking about buying MRE on the ASX, what sort of investment horizon should they have in mind?
I think with all of our investments, that they're available to be traded on market on a daily basis. But in the context of a well-diversified portfolio for an individual investor, I think that all three of those funds, MXT, MOT, and MRE, really warrant a longer-term hold. To really get the benefit out of something like an MOT and MRE, you're looking to hold for a longer period than you might MXT. MXT is monthly income, monthly distributions. Its NAV isn't really expected to increase or decrease because the investments are in private debt investments. And if we manage the risk properly, then we're delivering to our investors. In MOT and MRE, investors have the potential to gain upside and increase value or higher total returns. And that recognizes that crystallization of those returns may take some time. So it would be a medium to longer term investment in MOT and MRE.
So for an investor looking for regular income and diversification away from equities and term deposits, why should they be looking at MRE right now?
Well, I think the most attractive feature of MRE is if you look at that fund or that vehicle today, we've got a demonstrated proven track record within our real estate debt fund that launched back in October of 2017. Over that period of time, it's delivered 6.85% net to investors over the 90-day bill rate, and it's well diversified across 145 plus positions. So lower risk of credit loss and a demonstrated proven track record over a number of years of managing credit risk and delivering on very attractive returns for investors. So if you look at MRE and you say, okay, I think the debt portfolio is acceptable and it's worth 100 cents in the dollar. If you look at the traded price of MRE today, it's at a big discount to the NAV. But if you understand what's driving the increase in NAV, it's really the progressive completion of the projects, which really is factoring in the future after-tax income distribution that will be paid to an investors. So investors today buying MRE are effectively buying future income distributions at a big discount.
Andrew Lockhart, thank you for your time.
Thank you.